All right, everybody, welcome. I think we're live. Trends with Friends. I'll trust the Twitter and YouTube gods behind the scenes to make sure it happens. Today on Trends with Friends, I am in Huntington Beach at Josh Brown's Future Proof, which is a gathering of people babysitting capital, which is a growth business. There is no bigger growth business than babysitting money printer go burr around the world.
70 trillion making a transition.
Shocking that the wealth management business is a growth industry when the printing business has been a growth industry for 20 years. But a real boom. It's kind of unsexy, but it's my favorite trend because it's just so obvious and deep. But to go less obvious, nobody better here than Mike Maples. Mike Maples Jr., I guess, because now I'm finding out your dad was at Microsoft, I guess, through Michael Parekh. So welcome.
Yeah, I call him the real Mike Maples.
The real Mike Maples, yes. It's like that old, will the real Mike Maples please stand up? We're old enough to remember that show. Yep. And he's in an undisclosed location. He looks rested and tanned and healthy. And obviously the AI whisperer, my pal Michael Parekh. We are not going to talk about stocks, although, we always end up talking about stocks because the market caps of these beasts are hard not to talk about. But Mike has founded Floodgate Partners. Obviously, he's gone to Stanford and Harvard, pre-encampments. He was there pre-encampments, so please don't. Encampments weren't a thought in anybody's mind when he went in the 70s or 80s. When did you graduate?
No, I was in the 90s, but I'd tell everybody to be unconventional, and then I go to Harvard and Stanford.
You went when it was acceptable.
Yeah.
So you have done some incredible things. I think it sounds like you grew up around the tech industry because of Microsoft.
Yeah, my dad was at IBM pretty much my entire childhood. And so he was friends with this guy, Don Estridge, who was in charge of the original PC project. And so we had one of the really early versions of the IBM PC at our house. And my brother and I used to fight over who got to use it. And so his solution was to give each of us 1 hour at a time. And whoever fed the dogs that day got the first hour. And so that was my introduction to the computing industry, learning how to program.
What was the interface? It wasn't a mouse. It was just a keyboard.
Oh, just a keyboard and monochrome display and, advanced basic and Pascal and just learning how to do it.
And so you are a geek then, right? You and Michael both are geeks. Mike, I got to call it MP and MM. You guys are geeks. So, because I got an Apple from my dad and it had a mouse. I guess the first one was the Macintosh. And as curious as I am about everything, I'm not curious about computers, which is what makes today exciting. I don't need to be curious about computers. I think this is my era finally, where the interface has changed and computers kind of melt away in a way. But so you were curious about computers. Did your brother go in the industry too?
He did, yeah, for some time. And it's interesting because I was more of like a hobbyist. So my first ever job, I was a professional calligrapher when I was a young kid. And there was this thing called a koala pad. Michael might remember this. And you could draw on this pad and it would draw on the screen. And so I wrote this program that would simulate calligraphy nibs. So when you would draw on the pad, it would draw with a slanted sort of imprint on the screen, and I could do calligraphy characters on the screen. So I never thought of it as an industry or as a business or a way to make money. Right. I just thought it was just really interesting and empowering and fun to fiddle with. That's kind of how I got started with it all.
And was it the same for you, Michael P?
Very similar. I'm a finance geek by background, so I didn't have Mike's deep tech side of it, but technology was a hobby. So when the first computers came up in 78, 79, I remember, I started at Goldman in 82, so I was starting to make some money. Basically, almost all of my disposable income was going into the computers. People would come to my place and I would have the latest of every Mac and PC, and I would be mucking around with, Mike, you mentioned Pascal, Borland, and all the software from every company. I was self-taught. I taught myself all of this stuff and tinker. You mentioned QuadPad and every interface from music to MIDI and etc. So yeah, self-taught in terms of how software and hardware can do some fascinating things. And then obviously because of the finance background, very quickly, how do we make money from all this was the next question.
So Mike, just want to get, because we don't keep it short, but Floodgate, what does the name mean? When did you start it? Why did you start it? You made some incredible investments, that I know very well, Twitch and Twitter, but many more. So tell us a little bit about Floodgate. What was the original plan?
Yeah, so I'll give you the quick version. So, I was living in Austin, Texas, and I'd been involved with a couple of companies that had done pretty well. Tivoli Systems, which went public, was bought by IBM. And then I started a company called Motive, which went public and was bought by Alcatel-Lucent. And while I was in Austin, I just saw what was happening in San Francisco. It was kind of time to get the party started again with the internet. People were starting to talk about Web 2.0 and there was the O'Reilly conference and everything. And so I went up to that and I realized I had to get back to San Francisco. So I'd fly up every Sunday and stay in the Valley till Thursday because my kiddos were still in school. And I would just try to get attached to things happening in Web 2.0. And in the course of doing that, I started to see people like, say, Kevin Rose, who'd started Dig for $1,500 over a weekend. And these guys were all wanting to raise about $1 million. And what we now realize in hindsight was the beginning of the lean startup movement. I just kind of stumbled right into the center of it, and became friends with Steve Blank, and he had a class and he was talking about customer development. One of his proteges was Eric Ries. And so I kind of, my thesis was that 500,000 is the new 5 million. And I just raised a fund off of that premise. And we just kind of never looked back. That was we had a couple of early wins. Dig didn't end up working out as well as it could have, but it was a great investment at the time to be part of. It gave me a lot of street cred. And then my first ever angel investment was Odeo, which Ev gave me my money back.
And you stayed in. So obviously you had a chance to sell. So
yeah.
Right.
Yeah. So, but I think that a lot of success in the venture business is a function of getting lucky in your first 5 years. Yeah. And I think that people radically underestimate the importance of that. And whenever I run into a fellow VC who says, "Oh no, I'm successful because I'm way smarter than that," I'm always like, "Okay, well, when was your first big hit?" And every time it's in their first 5 years. And so I'm like, "Okay, I rest my case."
Yeah. So this is what I want to talk about. Like, I met Michael Parekh through Fred Wilson. Like my first, as a hedge fund guy, my first big idea, because again, I'm not an internet guy, was like, I'm going to create CNBC on YouTube. And I cold emailed Fred Wilson. I knew him from his blog and he was like, I love that idea. I didn't know he had invested in thestreet.com and I didn't know Michael Parekh knew Fred Wilson. And so I can't get over how many people take credit for being smart, if you were the only thing that would be interesting, Mike and Mike, to me, is if you didn't make money, if you landed on Earth as a curious person in 2006, even considering the great financial crisis, which obviously slowed things down for 2 or 3 years it really separated great founders from posers. So, which really led to a great era between 2006 and 2014, because you had to get through the great financial crisis. You gave away a lot of your company at the beginning. But you had this explosion of, there wasn't even the iPhone in 06 when Twitter and Odeo came out, right? And I started StockTwits. There was a BlackBerry. It was the web and a BlackBerry.
Yeah. It was also the internet ice age, remember? 2002 to 2008 was the best time from my perspective. Mike, you would agree, because we didn't, you said 500,000 is the new 5 million. There weren't big pools of capital coming in to flood everything. And just like, it was like, I remember Mike Arrington starting TechCrunch and that whole ecosystem that people were looking for each other to talk about tech, but there weren't that many people in the scene because it wasn't fashionable at the time.
Yeah. And I guess, Howard, I would, I might sort of modify the point you made slightly. Like, yes, I do agree that there were lots of ways to make money in that window of time. But I do think that what I've seen is that if you're going to be successful as an investor, it's kind of more important to have the right vantage point, to have some type of a proprietary vantage point that lets you see something that's not obvious to other people. And I didn't, finding lean startups, that was not a premeditated act on my part, right? It was just
Yeah.
like I could have walked through 20 different doors, and that's the first one I walked through. And I can only explain in hindsight how profound that was. But it drove a lot of my investing strategy, because I like to say, whenever I look at a startup idea, the first question I ask is this from the future? And like a lot of times, so I'll give you an example. I'll get pitched by somebody. They'll say, I have a mental health startup. There's a mental health crisis in this country. And I'm like, I agree. Why is your idea from the future? Well, in the future, I believe we need to fix mental health. I'm like, that's not what I'm saying. I'm not interested in your ideas about the future. I want to know why you're living in it right now today, why you're living in a different future than other people are living in, because William Gibson's right. The future is already here. It's just not evenly distributed. So like Andreessen, right, when he does the Mosaic browser, he doesn't care about a market for browsers. He wasn't even a business guy. He was just trying to make the internet useful for him. And he was living in a time machine at the University of Illinois. And I realized in hindsight, I just stumbled into a crack in space time, right? The core assumptions of venture capital, $5 million, Series A, 40% of the company, those assumptions were about to become invalid, because the cost of starting an idea was about to drop tenfold. And so there's just, but I didn't know that. It was just, I just happened to be living in the future. And I find that that's quite often the case with these startups. Like the founders almost feel guilty for finding the secret. They're kind of like, I wasn't doing anything smart. I was just pursuing something interesting for its own sake. And I stumbled into this thing, and it was obvious to me, because what else are you going to do? And so, a lot of investors I've seen do well, that rhymes as well in what happened. For some reason, they got a view onto a situation that wasn't the common view.
Yeah, I take full credit for immersing myself, but I take very little credit, because it would be more interesting if I had not made money. How target rich the environment was. I never bought into lean startup. I just came out of the hedge fund side hating, I 2002, 2003. I'm like, okay, the only way to be a hedge fund is to say I'm going to be an an index. Like, what's the point of being like the world was going the end? So I got that right, got out of that business, and I got dropped in a world where YouTube was coming out, and I'm like, it was all cat videos. So no one even knew what to do with it, as you know. And I'm like, I'm just going to make like Second City Television. I'm going to turn CNBC into a 24-hour YouTube channel. And Fred Wilson just happened to be the call. And he introduced me to this unbelievable, Brad Felt, Roger Ehrenberg, Michael Parekh, Andreessen. I pitched to everybody, and it was like, yes, 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 except Mark, who hadn't started his firm yet. He was in the middle of starting his firm. So I get dropped into that world. Today, we live in a world that feels like the complete opposite. It feels like everybody is telling people how smart they were in the last boom, and their founders. And, I blame YC, and God bless them. They're allowed to do what they do, but they're selling a playbook that doesn't exist anymore. What was abundance, distribution has now become scarce. What was difficult product skills are now table stakes. So I'm confused. I've been confused for 4 or 5 years. What has it been like the last 4 or 5 years? Are you yelling at the machine as much as I am, or are you just at peace with the fact that here's my rules? Like, we tell people, here's our rules. They may not make sense to you. Good luck if you don't. So how has it changed for you?
Yeah, it's funny. It's changed around me a lot more than I've changed. And so, I'm still a seed investor. Sometimes I feel like every couple of years, I've got to go up and down Sand Hill Road on a charm offensive to say I'm still a seed investor,
Yes.
still really seed investing. and I've never changed that in 20 years. And so, my business is hard, but not complicated. Roughly 15% of my investments either need to make 20x or 100x on the first check. And if
Mhm.
I can do that, I'll make a 10x fund. And
Yeah.
like, that's the business. And so, in order to find those kinds of projects, I have to find, I believe, founders who are living in the future for the rest of us, who are tinkering with inflections, have some fundamental insight about what's missing in that future. And then we need to get it at a price where there is a theoretically possible way to make 20 or 100x on our first check. And if all of those things are true, we can still do well. And so I'm just trying to stay in my circle of competence, right? I try to steal a lot of the good ideas from the quote unquote real investors, the Buffetts, the Mungers, the Howard Markses of the world, and try to understand where they apply and where they actually the opposite applies, when it comes to startup investing. Like, so for example, people talk about margin of safety and value investing. Don't lose money is rule number one. Rule number two, don't forget rule number one. In my business, rule number one is don't pass on Airbnb. And so you don't worry about a margin of safety. You worry about a margin of asymmetry if you're right. And so, it's a different type of investment. It's given that it's 85% likely I'm not right. How right can I be, or do I need to be in this idea for it to get the kind of returns that we want? So it's just a kind of a different way of showing up in the world, right? But I find that people come and go, they change their strategies, they raise big funds, they raise small funds, they enter every market, they don't enter markets, they exit markets. And we're just kind of still doing what we did all along. The prices change a little bit here and there, but it, hasn't really changed too much.
And so do you find yourself mostly, so when does price, so, when I was learning from Fred, he was like, if everything lines up, and this is pre-network effects. So Fred and Brad Feld and all these guys were like, they understood network effects and before Twitter and YouTube and Facebook and LinkedIn and AWS and the mobile phones that I don't know how they notice. So they had the insights that like price kind of didn't matter back then. So when deals were getting done in '06, we were doing deals 1-on-2 stocks, which I raised
Right.
60 grand on a $600,000 note. Dig was probably a 2 million pre or three. I don't know. What was Dig at the
That's
time?
about right. That's about right.
Yeah.
Yeah, maybe it was
Right? Like,
maybe it was expensive. It was 5 pre because it was the one of the top 100 sites on the internet.
yeah. And Kevin Rose had an audience, yada, yada, yada. But like
Yeah, I invested in Twitch at 3 million pre.
3 million pre came in, he had a camera on his head, and was he wearing pants?
Yeah, he was hoodie. Yeah, it's kind of like a Wild Western movie, but he was wearing a hoodie and a camera on his hat instead of a
Yeah.
cowboy hat and chaps and stuff. But it was
So you
fun.
And what was it about Twitch? Just him or the idea of broadcasting or what narrowcasting? What do you think was the future there?
Yeah, and so and this is why I kind of always return back to it's easy to misremember how this stuff happened or to think you understood things you didn't really understand at the time. Even founders remember knowing things that weren't so. And I just remember I'm sitting there in this coffee shop and I'm talking to the Weebly guys. This ended up being a pretty profitable 2 hours, and I decided I'm going to invest in Weebly. Invested in them at 2 pre. And they say, this guy walks in the coffee shop and I'm like, that's a weird looking dude. And they're like, hey, did you check your email? And I was like, what are you talking about? And they said, we wanted to introduce you to our friend, Justin Kahn. And I realized this guy's walking in the coffee shop to come sit at our table. So he sits at the table. He goes, I'm Justin Kahn and I'm doing a 24/7 broadcast of my life. And that's what this camera's for. It's recording all the time. And then he sets the laptop down in front of me and I'm on it because the camera's pointing at me. And he's like, you're on my show right now. And I'm like, Justin, come on, dude. This is one of the dumbest things I ever heard. And he's
Right.
like, you're supposed to be a seat. Why are you shitting on my idea? You're supposed to believe in this stuff. And I'm like, Justin, come on. First of all, it's not even reality TV. That's not how reality TV works. The way reality TV works is they record like a week's worth and they condense it to 22 minutes. Nobody wants to watch you all the time. It's like watching a fish cam or something. Like you're not even describing your business correctly. And I said, but while we're here, like what's in that backpack? What's going on here? And he says, well, the internet's a hostile networking environment. We got this guy on our team, Kyle, and he's designed this system that integrates EVDO cellular with internet software, and that's what allows us to stream. That's what allows me to go anywhere. And I thought, that's kind of interesting. And then later that night, I checked this guy, Justin Kahn, out online, and I hear that he's got this company called Kiko, which was a Ajax calendar company. And Google had just launched Google Calendar. And so they're like, okay, we're out of business. So they decide to sell the company on eBay. And they do for $250,000. So here's these two 23-year-old kids.
And they filmed it?
No, but they'd sold their prior startup. They'd sold for $250,000 on eBay to 2 cows. And I thought, who does that?
2 cows.
Like I've never even heard of anybody selling their company on eBay. And fortunately, I mean, now I know some things I didn't realize at the time. At the time is all instinct, but like now I realize that the things I talk about in my book, Pattern Breakers, that Justin embodied a lot of those kinds of traits. He was tinkering with stuff. He was solving his own problem. Justin wanted to be internet famous before there was a term for influencers. And he was creating the system he wanted for him. And, he was intrigued by the idea of being internet famous. And there was some hard technology that harnessed inflections. Kyle Vogt, it turns out, we now know in hindsight, a total.
Was he technologically savvy? That was the reason why I didn't get super wealthy off this, because I truly wasn't technologically savvy. I understood what these things were, but I didn't know how things worked.
Yeah. Kyle Vogt is an extraordinary builder.
Okay.
Just like, like at the level of like Nate at Airbnb or some of these guys, I call them super builders. And that's another trait I've seen. So like you have the pattern breaking founder who's willing to think, feel, and act differently, willing to engage in unconventional activities. Lyft launched an illegal service in San Francisco. So there's unconventional actions in addition to unconventional thinking. But then you like to have that super builder on the team because you never know what's going to happen. So like what happened at Twitch, there was this time Justin TV, NBC calls him on a Friday and says, this is a courtesy call. There's a restraining order. We're shutting you down on Monday because NBC, I think it was, has bought the rights to the Olympics and we can't afford to let you guys stream it illegally. So you just can't stream that month. And like if you can't stream for a whole month at all anywhere, you're just out of business, right? You're done. So they say, well, there's got to be a way for us to fix this. You let YouTube stay online. And they're like, yeah, but YouTube has this entire infrastructure that lets us reject content and stuff like that. And they said, well, what if we had that for you? And Kyle Vogt builds it over the weekend. And it's like, without that, there is no Twitch. There's no Justin TV. They're out of business. And it's like, but like the NBC folks didn't believe there's any possible way they would build it over the weekend. Next thing you know, sure enough, Monday morning, they've got it and they don't shut them down. And so you look at Nate over at Airbnb, which unfortunately I stupidly passed on, but like, he could build anything. He could build payment systems. He could scrape Craigslist. And so the super builder buys optionality in the startup because you never know what's going to need to be built in the future because the future's so uncertain. And so if you can build whatever arbitrary thing needs to be built, you have a huge advantage over companies.
And to your book, Mike, the super builder also can build pivots. 85% of your success are pivots. I found that fascinating. I audio became Twitter, etc. Slack.
Yeah.
And what made you stay? I got a million questions. And Michael must too. So I apologize. What made you stay in it? You had the chance. I mean, I know from Fred, like people had the chance to take their money back. So Evan gave people the chance to take their money back. What was your instinct there to just say, go with it, make the pivot, I'll stay in?
Ev Williams is a genius.
I think he is. Like, I mean, of all the people there, you go from Google Blogger, like the product genius of Blogger, which was my first blogging product that I used, and I miss it to this day, was how, at that time, how easy and magical that fucking product was. And he sold it to Google, probably make his first buck. And I missed that product dearly.
Yeah.
So that's why you stayed in.
Well, so audio was a funny thing. So I was a huge podcasting enthusiast, and people don't remember this at the time, but you had to get the open source. Like you got the iPodder software, and I had an aux input in my car, and I would listen to podcasts, and I was like, this is going to be huge. And so
Wow.
then Ev comes out
Wow.
with audio, and I was like, this is going to be the one. And so I invested in it because it was a very nicely conceived, well thought through product,
Oh, the
even
guy
at the
is like a
beginning.
product savant. Yeah.
He's so good, and he just has a way of describing things that gets to the essence of what he's trying to do. And so I really liked it. Well, a week later, Apple decides to give podcasting away on iTunes, and there's just no recovering from that, right? Because at the
He was
time,
somebody's bitch. You can't, like Fred says, he can't be somebody's bitch.
well, and it's just at the time there was no device to play things back on other than the iPod,
Got
and
it.
so like they had the entire ecosystem, and it's free, and so there's just no way you're going to compete against that. And so I've tried for about a year or so, and we would meet from time to time, and but he'd just be like, I just don't see a way out of this ultimately. And so he decided to give people their money back. And I was like, okay, well, first of all, you don't owe me my money back. You win some, you lose some. But there were other investors. I'm not going to name and shame, but there were other investors who kind of disenchanted and kind of strong arming him, right, to do some things. And so I said, look, I'll take it back, but if I hope you'll let me invest in whatever next thing is. And he says, well, yeah, I'm working on this thing. We're going to call it a TWTTR or voicemail 2.0. And he described it to me, and I remember thinking, okay, now I probably lost the money for sure. Cause it's like you say what you're doing, 140 characters or less, and that's all it is. And there's no revenue model. There's no roadmap. That's all it does, Um, I just thought that, I thought it was an amazing gesture for him to give investors their money back. And I just thought he was really talented and smart and creative, and, you know, why not? Um,
All right, so I wanted to, I mean, with fuck everybody listening, because this is fun for me and Mike, but one more question around here, and let's talk about the future a little bit. But
Sure.
Fred, so you must have met Fred Wilson over the years then.
Uh-huh. Yeah.
Yeah.
I don't know him as well as I'd like.
Nobody does. Nobody does.
So I read
Except
his
for
blog
Gautam.
AVC from the very beginning. So the very beginning, when I first started angel investing, I had an RSS reader and subscribed to all these different bloggers. Fred Wilson
Yeah.
had AVC, and Hornick had his
David
uh,
Cowan, and it was Brad
David Cowan, who
Feld,
has
and
time
yeah,
for this, and
yeah.
Brad Feld had Feld thoughts, I think, and
Clavier was great too. Ed Sims. There were some great blogs back
so I
then.
would read all these things, and I didn't meet Fred until a little bit later after he'd invested in Twitter. The thing that I really appreciate about Fred and his whole outfit actually is their commitment to thesis driven investing, and
Yeah.
not just in a platitude rhetorical sort of way. Like they really embody that in their culture, and I just think they've done a great job of it. And
Yes.
it's easy to say, oh, well, I could do that too, but like it's hard as an investor to stick with what works for you and do it in a disciplined way and not get distracted by what everybody else is doing. And I think Fred's done a pretty magnificent job of that. And I know this because I study these 100-bagger startups.
Yeah.
And I'll so like MongoDB, I'll look at it and it's like so many of them. I'm like, damn,
Yeah.
Fred
Albert did
Wilson.
that one, I think.
Yeah,
Yeah. Yeah. Yeah.
I'm like, those got USV figured that one out too.
Yeah.
And
Dude,
it's like you just look at it and you're just like, man, alive. They've just been on it so many times, and in ways that I don't think people fully appreciate. Right? I think that
they
the
don't.
insiders
They
in the
do not
industry
appreciate
know
it.
that their returns are good and stuff like that, but I don't think people really understand the level of I think those guys, and I think Roger Ehrenberg have
Yeah, and they're
both
both
done.
like Roger.
Yeah,
I got lucky. I got Roger and Fred on text,
yeah,
and I don't try and well, Roger I bug all the time because he gets so annoyed so easily with me that it's charming. But Fred, I treat much differently because it's a different relationship. But to come of age where Fred's introduced me to Michael Parekh and Brad Feld and Jeff Clavier and David, like seeing these people at like Web 2, there's just nothing like that today. So I hate being that guy that says there's nothing like that today, but there's no way there's anything like that today. We've lost the script in terms of seed mentorship. So no one wants to talk about the old days for the wrong reasons. You talk about the old days because patterns. You discover patterns by going backwards. Go ahead, Mike. And like, no one can appreciate how good Fred was because not only did he understand tech, he would back idiots like me who had no tech experience, but had this. I walked into Fred's office with CNBC on YouTube because I grew up a frustrated comedian. And now I had a chance to build Second City, make fun of CNBC all day with a TV show with no tech skills. And he goes, I'm in. And not only am I in, meet Mark Pincus, meet Michael Parekh, meet Mark Andreessen, meet Brad Feld, blah, blah, blah. And you're calling them on your StarTAC, and they're not looking at the pitch. They're just hearing that Fred invested. So they're like, I'm in, and then they hang up on you. That was fucking the world pre-social. And I guess that was the original social signal, but it was only a few people that had that power. Then it became like a fucking thing. Go ahead, Mike.
I just want to point out we're tying, there are a number of threads here and they're tied together and they're sequenced. History rhymes. So when Mike, you're talking about, Justin coming in with a camera on his head, I remember 10 years prior, a couple of guys saying, hey, we're going to stream radio stations over the internet in 96 and 97. And I'm like, oh, wow. Do you have permission to do that? And they're like, we'll figure it out. And it turned out to be Mark Cuban and broadcast.com. And we helped, sell it to Yahoo for billions of dollars. And
Well
Mark
played.
Cuban is Mark Cuban now today.
I hope he's
And
got
so-
you in his will.
No, I interacted with a lot of it because he's one of the
He's always
smartest
in love
plays
with
that
him.
he ever did. He claims today, and he did. He hedged himself.
Yep.
His
He
Yahoo
understood
position.
stock
And-
markets. He understood stock markets.
and so I would, I would talk to him all the time on Yahoo up and down while he was getting his position collared. Anyway, but the point I'm getting at is, the instruments change, the technologies change, but the opportunities are always there to, as you said, pull the future in and live in the future. And so you have the Mark Cubans. You had Rob Glazer, who said, okay, I'm going to create the software and take, and he created real networks.
Real networks.
That was Jim Breyer's first big hit before he got to Facebook 10 years later. And the other thing, since we're talking about seed and investing in Web 2.0, Web 1.0, we have to remember that each tech wave, it builds on the fact that the success of the prior tech wave and all the money that was earned by a lot of entrepreneurs that then became investors in seed and growth and so on later. It started with PCs and it went on to internet. And by the time Web 2.0 came along, there were enough of us, Mike, that we could, pass around 25, 50,000 here and there and go on to the next thing. And of course, by 10 years later, to 2015s and 2020s, and we're going to get to that today, the scale of the opportunity is bigger, right? Because back when we were doing this stuff in Web 2.0, et cetera, there were maybe 2, 3, 4, 500 million people online. Today, there's 3, 4, 5 billion. So anything we do that brings the future forward requires much more capital, much sooner to scale. And those are the imperatives. So there's the financial layer, the technology layer that is people are always tinkering. There are always the people who are trying to bring the future forward. And that's what makes this so exciting. And it's wonderful that, we've got this series of waves to all collectively learn from and build on.
Yeah, agreed.
Thank you.
And we'll,
Go ahead.
we may get to
Mike.
this, but because of this wave effect that you're describing, I think there might be reasons to be optimistic, and maybe we can get into this. But when I was a kid, we were talking about this earlier. There was the era, I call it mass computation. It was Moore's law. It was get a computer on every desk at every home. What happens if computing power becomes asymptotically free? And then George Gilder wrote the microcosm. Then he wrote the telecosm about mass connectivity. And now you say, what happens if communication bandwidth becomes free? And rather than a computer on every desk in every home, you try to connect everybody in networks. And the reason that it was profound, I think, was that the new startups were counter-positioned to Microsoft. It was no longer the battleground of competition wasn't on the desktop; it was in the network. And so now you had the conditions for the incumbents to be disadvantaged rather than advantaged. Because, people forget this, but there weren't many desktop software companies that were good that were created after 1990, right? It's like Microsoft just hoovered it all up. And so now I think we may be entering an era of mass cognition. And I think that there are going to be certain cognitive tasks that are going to be commoditized. And all of my instincts tell me that the same will be true as of the past, that there will be counter positioning opportunities for startups, and that it'll seem like it's a bubble. Just like in the early days of the internet, you could have argued it's a bubble. It kind of was. You had all the guys investing tons of money in fiber, just like they're investing in GPUs now. So you had to hold two facts in your mind at the same time, right? Amazon was overvalued in the short term and massively undervalued in the long term.
Undervalued.
And so you had to navigate that. You had to navigate that situation, but it was an exciting situation and it was transformative to humanity. And I think we're heading into one of those eras.
And it's exactly the same.
A lot more to it than that, but I
more
think we're
zeros.
Yeah. Okay, so more zeros. So now let's get to today, and thanks Mike for doing this, and hopefully you'll come back because of Michael, not because of me, but hopefully you'll come back. So what is different? What does Floodgate see the same and different today? Size of fund, size of check, who you're looking for. I know the pattern, but the book's phenomenal. Mike and I have read it. Jason, stock traders I have reading it. Because the title matters. Who came up with the title? I got a million. Who came up with the title?
That was me. Yeah, I'm guilty. Yeah.
And title matters. My first book, The Wall Strip Edge, they paid me $80,000. I let them name it what they wanted. It was going to be called The Twitter Trend. It would have been a bestseller. Now 4 people in Germany have read it instead. It's the best book ever written. And people love the book. So Pattern Breaker's great name. You think in patterns, you think outside the box. So today, prices are crazy. Whether you can argue with me over this or not, valuation matters. But assuming it doesn't, or do you believe in that valuation matters?
It has to matter because, like,
thank you.
They say that. Let's see if my camera just paused there. Sorry about that.
We can hear you.
Okay, you can hear me. Okay, that's nobody. It's always good care.
No, you look great.
I guess the thing. Here's the thing that I think people don't quite get. So, like, let's just take an example. So, my partner Ann invested in Lyft at a 5.5 million post money valuation, and she probably made 250x on that investment.
Mm-hmm.
If she'd invested at 25 post, she would have done well, right? She would have done like 40 or 50x. But 250x is like, ooh la la, right? Like that's like really good. And so, like, whenever I look at an investment, I say, is there a way that if it goes our way, that I can make 100x my money on this first check, given the dilution I'm going to get someday?
Oop, we lost him. So hopefully he can dial back in. Are you there? So Mike,
I'm not sure what. Yeah, I'm not sure.
We got you back.
There we go. That was quick.
You got it back.
So
okay.
So like talking about you've got to get the markup.
So let's just take an example. There's a company called Applied Intuition that I funded in 2017. They do AV simulation software for the car companies, and they also help with rollouts of EVs and software-defined cars. I think Casser Eunice is one of the best founders I've ever worked with in my career, and I knew that about him even before he'd started this. Yeah. Well, everybody he talked to wanted to fund it. So he talked to 2 VCs, John Doerr, Mark Andreessen. They both said, we're in, we want to lead the round, let's go. So Mark ends up doing the deal, and I end up co-investing with Mark. And the price was something like 45 million post money, in that range. You say, okay, well, that's overpriced. Well, they just raised earlier this year at 6 billion. And so, I'm roughly 100x the money on that first check. Now, okay, how often does that happen? How often is a company worth 6 billion? Not very often. And so around our table, if somebody comes in with a project and they're priced at 45 post, I'm like, maybe we've made money doing those before, but is this guy Cass or Eunice? And is this opportunity applied intuition? Because if it isn't, it's overpriced. So like the thing that people don't get about seed is it's like all investing, you have to get paid for the risk that you take. And you're taking an insanely high risk in seed, no matter what price you pay. And so in the rare event that you're right, and it is a rare event, even for Fred Wilson, right? Even somebody that good, it's a rare event.
Correct.
In the rare event that you're right, you got to get paid for it. And if you're paying 5 times the price, you get paid 1/5 as much. And so, you just have to get paid for the risk you take. And so the way I try to stay in my circle of competence is to say my job description is to get 100x when I'm spectacularly right on this check. Under what circumstances could that conceivably happen here? If I can't convince myself that it could ever happen, no matter how good this is, then I can't do that deal, right? I have to walk away. But what I don't do is I don't have some dogmatic idea of I never pay more than 15 post or whatever. I always ask, can I make 100x if it goes my way relative to everything else I could do with that money? Is the way I think about it.
And okay, I mean, there's no reason to talk about it because it is correct, right? Like I did not see no, it's correct because I know Fred in his heyday, and he doesn't share as much as he does publicly. And so when I passed on Twitter and Zynga 3 on 17, that was an era where deals were getting done. And this is my problem today. No, it's not a problem, sorry. It's my hurdle. I'm saying, are you Mark Pincus and are you Ev Williams? Because they were raising so Fred understood, as you understood with that applied deal, and Michael Parekh and I try and understand this, is that what Fred understood, and Fred offered me Twitter at 20, I go, how am I going to fucking make 20x? How is this going to be worth 400 million? So I was so fucking wrong that it's funny, but we were pre-iPhone, pre-AWS, and not really mobile web, right? Like Twitter was so ahead of its time, as you got right, that I couldn't go from the 2 million valuations to the 20 million valuation, no matter how good the founder was. So and Fred listened to me as Howard, if everything lines up and price is the only reason you're not going to do it, do the fucking deal, right? Like do the work. And if price is it was so profound and I personally can't get over that hump because he's Fred Wilson and I'm Howard Lindzon. You obviously have to get over the hump. The way I look at it is I'm going to make my money between the seed and the egg. So if I can't make 5x, so I talk to the founders, I go, listen, you want me to invest at 10. What does a $50 million valuation look like at A? How are you going to take this money and get yourself to a 50 million valuation? Whatever rules you want to apply. So for me, it's more like you, it's got to return the fund. But like I try and talk to the founder and say, guys, I make my money. I work hard, meaning seed to A. This is where we got to help you. If you don't believe we can help you make 5x, why are we working together? And if I don't believe you can get 5x with our help, you don't want my money. And so it feels like the script is lost somehow. And then the other problem that I see, Mike, is you understand tech enough. So when Andreessen's, I've seen the data room. You go in the data room, they're 1.5x over 10 years is kind of like their data room. And I'm like, the odds of these other seed founders that accept Andreessen's prices are betting that they can pick the one company that Andreessen gets right. So it's like there's so much bad signal out there. I worry about that. So, but yet, as you said, it's a great time to be optimistic. So how do you deal with that, or you don't care about that at all?
Well, and this is where I think it's so valuable to have a working opinion of your circle of competence. And here's why. Like I can't time markets. There are times where things feel overpriced, or there are times things feel attractive, but like I don't trust my feelings that much. But if I say, okay, I need to make 100x if it works, if every deal I look at is priced out of that range, I'm not going to do many deals. So my pace is going to slow down. But I don't slow down my pace on purpose. I don't say, oh, wow, everything's overpriced. I'm going to slow down my pace. It's just an emergent property of everything being expensive. And so I'm like, okay,
Correct.
Silicon Valley will make more interesting startups, and there'll always be great founders. If the broader context is a little bit overheated or people are getting carried away, not my problem. I just need to worry about the situations where I do want to play. And if I don't find any, I'm not under any pressure to do anything about it. I don't have to write any checks. Nobody's forced me to do that. And what I need to do is I just need to realize there's an opportunity cost of my money and my time. And so like Twitter at 20 posts was a fully described opportunity relative to all the other opportunities I could have considered at that time. That felt like a good one to me, but it was still expensive. But I was just like, that's the deal that's on offer. And I felt like at the time I didn't know about 100x this or that. It just felt like it was an important project in Web 2.0, and it was, the only way I was going to get in is if I was going to pay that price. And so that was kind of the thought process. Yeah. But I passed on Airbnb, so let's not give me too much. That was the dumbest. Brian offered me to invest in a $1.5 million valuation. It still haunts me.
Does it haunt you though? Like I find they're good stories. Like what was the true reason? Because it wasn't valuation. So what was the reason for passing? For me, it was truly valuation on Pincus and Twitter. So it doesn't haunt me because I had my boundaries and I didn't understand network effects and I thought Fred was nuts. So what was it about Airbnb that?
I just thought, well, so I met Brian even before he applied to YC. So Michael was advising them, Michael Seibel, and he introduces me to Brian. And at the time, it was basically hardly anything more than a WordPress site. And at the time, the host and the guest would be at the place at the same time. The guest would be on an air mattress, and a lot of times the host would serve like Pop-Tarts or breakfast, to the guest. And I just remember thinking, this is kind of crazy, and it was around the time of the Craigslist killings. I was like, what if somebody gets killed in one of these things? Like who knows? Like it was just, and it was, the presentation itself was so discombobulated, so he came in the conference room and there's a bunch of cereal boxes in the room. And I'm like, what's up with this cereal? I thought you're Airbnb. Why are you selling cereal boxes? And we had been pitched by a cereal company the week before, and Ann had read me the riot act. Why are we talking to cereal startups? That's the stupidest thing ever. And I said, yeah, you're right. Okay, I'm sorry. So then we come into Airbnb and it's a room full of cereal boxes. And Ann looks at me like, what's going on? You've gone off the rails again, And so, and then he's like, well, we're just selling these cereal boxes to fund the company. And I was like, okay. And he goes, and Michael says you prefer demos to slides. I'm like, yeah, that's true. So let's see the product. So he fires up the product. He can't get it to work. And so, and then I'm like, okay, well, why don't we just do the slides then? He's like, well, I didn't bring any slides because he said you didn't want slides. So we're 20 minutes into this meeting in a room full of cereal boxes, and I still have no idea what they do. We're just looking at each other in this conference room. And I just didn't, I knew that I knew he had this X factor. I introduced him, later introduced him to Reid Hoffman and other folks ended up funding him. But I just didn't, it just seemed too crazy, now I came to realize that sometimes it's the right kind of crazy. And at a $1.5 million valuation, that was just, I should take that bet all day long. I should have done that.
I had the same with shares at the time. It was 4 million val. I hounded Henry and he couldn't, I was just testing him to close me. He couldn't fucking close me. I was like ready to wire and I just had no objections, but I just something about him not being able to just push me in and I had no reason not to. The bothers me more than all my other ones. The funny thing is Fred passed on that too. I think Paul Graham had Fred's written about it, sent him an email saying you got to do Airbnb and Fred said no. So two great people passed on that deal. Michael, you were going to say?
No. I mean, I didn't have as much time with the Airbnb guys, but I vividly remember meeting them at YC in 2006 or 7, and it was a very short meeting, a lot of people around, etc. And the lesson I took away from that one was, for me, was that, and it's just a constant reminder: don't react to something personally. Because when I heard the idea of, people just living in your couch or you just living on someone's, I couldn't handle that. I couldn't handle that invasion of privacy, etc. But other signals were there. And so, fortunately, I ended up becoming a teeny small investor. But my point is, the lesson I remember for Airbnb is don't react personally to the investment, which is something,
Right.
you have to have your own list of rules. And that's one of mine, because that was one where I couldn't personally hack the notion of renting out my space to somebody else, a stranger,
Yeah,
etc.
I think my interpretation is not everybody should be a landlord, so I probably would have passed. So quickly, the future, Mike, Parekh is super excited. He's walked through his AI infrastructure thesis. Is AI Mike sat out crypto, wasn't excited after Web 2. Mr. Maples, what gets you excited today about tech and where we're at in timing? Because you probably didn't enjoy the last 5-6 years, not because you were timing the market, just because there's so many things discombobulated. But today, what's lining up? What's to be optimistic about?
So I'm still trying to figure it out a little bit because, I'm sure we've all seen some of these AI startups are getting funded in the seed rounds at just prices that I just can't even fathom. Right. And so, but what I find interesting is you could say two things are really interesting to me right now. The first is more of a macro thing, and it's this idea of certain types of cognition becoming commoditized. And so I think that there are types of fields where there's a type of knowledge that's in that field, and that knowledge is held by expensive people, and people pay high prices for that knowledge. And I think that there are situations where the relative value that's gonna go down a lot, and then it takes your mind in a lot of interesting directions. What type of pre-existing knowledge is going to become less valuable over time? What's the relative value of new knowledge versus pre-existing knowledge? Is new knowledge going to be mostly discovered by people or by a combination of people and computers, or by computers by themselves? In what cases might each of those happen? And so I've been investing in opportunities to make cognition a commodity in certain ways. Now, most of where I've actually written checks has been in enterprise software. So, Applied Intuition's a good example. There's another company called Cicero where they help the chief legal counsel of companies reduce billable hours to outsource law firms and stuff like that. They've done really well. But here's the thing I'm curious about, and maybe you guys have talked about it in prior episodes, or Michael, might be part of your thesis. But to me, AI also creates the conditions for a breakthrough in consumer. And so I think that the network effect companies kind of ended up dominating these networks, and they could just block good ideas from really getting escape velocity in the way that they once did.
First they help them, then they cockblock them.
Exactly. And so then now I look at consumer and I say, okay, LLMs empower people in new ways. So you could say, all right, well, how do LLMs empower people? There's a lot of ways: processing knowledge, communicating, problem solving, generating art and ideas, learning, assistance, cognitive augmentation, emotional support. And so there's like all these different things. And so I'm like, okay, I could imagine somebody using an LLM as an inflection that empowers consumers in a new way that would be disorienting to the Facebooks of the world, because you might not position it as a network effects business. You might position it in a whole different way, the way Google was different from Microsoft back in the day. And then the other thing that I've been looking for is perhaps you could have synthetic network nodes to overcome the cold start problem when you do want to create a network. And so, for example, this takes me back, but like when I was in a fraternity in college, you'd have like the phone tree, and you'd have the guy that like made sure people were going to the right parties. And, you had to have somebody who was on it to make sure that
curator, the curator,
right? And who's Malcolm Gladwell's book, The Tipping Point, that Maven type of person. And
Yeah.
and I think that when I look at what those types of people do, it feels like a lot of those traits could be embodied in an LLM. And so
Yeah.
it's not just that you're trying to have fake NPC types of people, but you might reconsider what a network node even is in the first place, and the way synthetic nodes provide value in ways that overcome the cold start problem for networks. And so I'm interested in that. So all my instincts tell me that whenever you have AI to me isn't just an inflection, it's a sea change, in the way that mass connectivity was, or the way that mass computation was. And when you have a sea change, you don't just have independent discrete events like the iPhone 4S with a GPS chip or something like that. The literal current of everything shifts direction. And it's not like networks are going to go away any more than PCs or mainframes went away, but the energy and investment shifts to the new stuff. And right now there's a little bit of a mania of spend on CapEx and things like that, but that doesn't
It's
mean
a
that the
good
mania is wrong.
bubble, kind of like
Yeah.
Lucent. Like you didn't like it,
Yeah.
but we're going to look back and go, thank God it happened.
And
There was,
it's the way capitalism happens in the Western world, going all the way back to the railroads, right? So like
yeah,
it seems like one of the ways that entrepreneurs get access to low cost capital when massive build outs happen is you get these manias, whether it's building out railroads or the radios back in the day, radio networks, or internet version 1.0. I just think that it's just the circle of life, It just, and you just got to be careful about, you're going to have situations where people are over investing, where they're not going to get a return, where there's going to be economic distortions. And that happened in the late 90s too, right? But that
yeah,
doesn't mean it wasn't exciting and that you didn't want to be in the game and watching what was going
yeah.
on.
What excites me is smaller than your ideas is I didn't like lean startups. Just, I like the idea of, we'd swung in '06, there was like 2-time preferred. So the pendulum had swung too far in favor of VCs by '06. I believe it
Mm.
swung too far in favor of the founders by 2020. I feel that we're now headed to not what I call lean startup, but lean business. There's never been a better time to build a lean business, and AI will drive that as well. Meaning, as I build StockTwits over the years, I was up against network effects. I didn't have tech skill. I mean, whoever backed me, as smart as they are fucking idiots, because you can't back a guy into a gunfight with a Ginsu knife. And so I went out into having to build for HTML5, Android. I have no tech skills. Well, who the hell is going to back that? Meanwhile, today, I've never been more bullish about vertical networks, because the deeper I go in the network that I have, the more growth I can get. It's weird growth. It's not sexy growth. It's just growth and organic. And then over top of it, as a creator economy using AI and all these other tools, I can build a massive, broader brand on top of it. So as
Yep.
dumb an idea as StockTwits was for the first 15 years, it's a huge idea just because we stayed alive in the next 20 years because of lean business, and the deeper you dig, the bigger your network gets versus the broader you go. So I'm bullish for, I can't explain it technically, but that's what I see happening with AI.
And what I wonder about with AI is, we got to a point, we didn't really talk about this, but whenever you have a sea change, I think you reach a saturation point. So I think that, Microsoft basically achieved a computer on every desk and in every home.
Yep.
And then the monopoly players start to become more extractive than additive when that happens. They have to, right? And so because the pie isn't growing as fast anymore, I think the same thing happened with network effects, largely. But I'm intrigued by this notion that, the number of connected nodes was an order of magnitude more than the number of desktop PCs. Is there going to be a world of synthetic intelligence where there's trillions of intelligent entities in networks, most of which aren't people? But like when your mind goes there, you're like, man, that would be a very different, interesting world.
Mike, I've already modeled it out.
Yeah.
I did a post. I'm already assuming every one of us is going to have at least 10 agents working for us in about less than 5 years. So that means if there are 4 billion of us today online, there's 40 billion agents. That is the underlying market opportunity, and there are going to be big companies and small and seed companies attacking those sets of opportunities.
That's right. And when you allow your mind to consider that those agents are going to be intelligent, because era of mass
Not
cognition.
intelligent.
Right.
I like to, the word intelligent is poisonous and toxic, because what the reason is because we're anthropomorphizing these things. We're making them human. They're not intelligent.
So
They're just qualitatively computing on probabilistic tables, on mass math matrices. That's all they're doing. So they're not intelligent, but they're more capable than the quantitative computing of the last 70 years, where 3 + 2 was always 5. These things are going to give you a range of outcomes on probabilistic based on our data that we give them.
Right.
So I just want to just touch on that, because whether you're a seed investor or a growth investor, once you start to put words like intelligent in them, you start to go into God AI and AGI and all these other things that become religious wars.
Yeah. So whereas I'm kind of like, maybe I need a different word than intelligence, but like I'm just intrigued by this idea of bundling and unbundling factors of intelligence. And you start to say, okay, if there's going to be hundreds of, let's say there's even trillions someday of cognitively enhanced entities out there.
Love it.
Okay, now I'm a company. Am I marketing to people or am I marketing to those entities? I'm probably marketing to both. Okay, so that changes marketing, right? And it changes PR, and it changes like a whole lot of it changes the way you think about your sales funnel. It changes a bunch of things. And so it just feels to me like if you have orders of magnitude more cognitively enhanced sort of entities out there in the world, that all these markets will get redefined and reimagined. And that's I think that's pretty exciting. I don't know exactly how it's going to play out. And fortunately, it's not my job to really, it's my job to know it when I see it. But, that's kind of what my antenna's up looking for.
I just want to add one more thing. By the way, I would recommend everyone get your book, Patent Breakers, and read it end to end.
I've been sending it out.
Yeah, I wanted to touch on your chapter 15, Dancing Elephants, the business of how corporations can be patent seekers. I bring it up because our whole conversation this morning has been on seed and small entrepreneurial investment. But I also think concurrently this time, there's massive opportunities for the big companies. And I'm not talking about just the OpenAIs and the Microsofts, the big tech guys, but every big company as well, to be patent breakers. You said, your dad came from IBM. I remember IBM is very famous for their philosophy, from the Watson Senior and Watson Junior to the notion of wild ducks. They encouraged, in one of the largest tech companies in the world, people to be wild ducks and out of the box thinkers, bring in the future, and gave them permission to do stuff. I'm where I am because I was allowed to be a wild duck within Goldman Sachs, as an example, in terms of pursuing a variety of things that allowed me to do internet and all these other things. So my point is, I just love for you to talk for a couple of minutes or a minute or two on that, on the opportunity for incumbents. We've on this show talked about how big companies ought to, there's a lot of opportunity that they can spin off companies, that they're doing acqui-hires.
Yeah.
There's a lot of opportunity for innovation within large companies. And given your decades-long experience, I would love to get your sense of that in the context of patent breakers.
Yeah. So I'll give the kind of the high level thought, and then we can go in as much depth as we think is a good idea. So the basic thing that I think I learned while I was working on this book is that startup capitalism is different from corporate capitalism. And so corporate capitalism is, you're trying to build a sustainable advantage and moats and persistent compounding. And, Buffett and Munger, guys like that, they're basically betting on a business's ability to compound more persistently than you think it will, or the rest of Mr. Market thinks. And if they're right, they make lots of money, they hold it for a long time, they do well. I came to realize a startup does none of those things. They don't have economies of scale or network effects or a brand or a moat, or that all they've got is the founders and their idea. And so startup capitalism is not about persistently compounding. It's about changing the subject. Like in evolution, you look at the fossil record, it looks similar for a while, and then punctuated equilibrium, an asteroid hits the earth and now you got mammals instead of reptiles. That's what a startup capitalist does. And so why does that matter? It's just a different value creation philosophy. And so if you're in a big company, the very fact that you're good at doing your business is going to hold you back when it comes to doing pattern breaking ideas, because it's the weakness in your strength. the strength of your company is that you've been able to persistently compound. The weakness in that strength is it's going to be hard to do something radically different. It's going to be hard to break the pattern. And so I think that another VC I admire, Vinod Khosla, has the right framing of this, which is what a company should do if they want to have pattern breaking ideas is they should take some fraction of their profits and they should invest it in projects that have 10% likelihood of 100x upside. And so, and you want to make those projects not very visible. Part of why Estridge succeeded at IBM on the IBM PC is nobody cared about what he was doing, right? He was just in Boca Raton, and he's like, okay, I'm going to take some Intel chips and slap in a Microsoft operating system. And, and so like one time, someone from Disney, and I don't mean to diss on them, but they were saying, we're going to do a Disney accelerator and we want you guys to participate in it. And it's got the visibility of Bob Iger.
Doomed to failure.
And I was like, oh man. And so like, you want, like what I find happening, like Cicero sold to the guy who's the chief legal officer of MasterCard. Well, he was running a pilot in a data room that was completely invisible to the company. And only after it achieves a 10 times upside does he show it to the AI czar at MasterCard, right? But that's what it usually looks like when pattern breaking ideas happen, because, the pattern breaker isn't necessarily better or worse than the corporate compounder. It's just they have a different risk profile. And you can't make the risk profile of a corporation apply to break through things. And so these days I look at a matrix, I say, innovation can be organic, it can be M&A, or it can be partnered, and it can be sustaining or pattern breaking. So like iPhone 1 was pattern breaking organic, iPhone 16 is sustaining. Facebook buying Oculus is pattern breaking. Microsoft acquiring Activision is sustaining. And then, IBM and Microsoft and Intel with a PC is pattern breaking, partnering. And then I would assert that Apple OpenAI is more sustaining. They're taking advantage of their distribution, their app store, and their brand. And so what I say to companies, big companies, is first of all, I don't know how to run a big company, but it's like being a good executive in a company is a function of operating well, yes, but it's also a function of allocating your profits well. William Thorndike wrote about this in The Outsiders. And so then you say, okay, how much do you want to allocate to those different types of things? Because all of those things are valid ways of creating compounding advantage or new advantages. But like you as the chief executive officer have to decide how you want to allocate your profit dollars to those different types of things. And then whatever those types of things are, you have to staff them appropriately. You have to have the right risk profile. You have to have the right financial expectations, the right time frames, all those things to succeed.
Well, you nailed it. I mean, obviously we could go forever. It's not fair, Michael and you. It's just fun to listen to you guys chat. What a thrill. Obviously you're excited. I mean, the main point is you love what you do. You can see it. Mike loves what he does. I love what I do. There's periods where some stuff just doesn't make sense. I think we're heading into a period that makes sense. What's so funny about this era is if OpenAI started in 2015, obviously I'm not a tech person. I don't even know what that, I'm sure if someone had told me what it was, I would have made fun of it. And that's the era where SoftBank and all the SoftBank clones started doing all the wrong things. And now here we are with, OpenAI almost 10 years old and people chasing OpenAI, and they're probably missing what you're talking about, what Michael's talking about, the 40 billion agents and the who are we selling to versus chasing OpenAI. So I think there is this, finally we're there. So it's kind of, we got to find a deal to work on, but finally we're there. Yeah. Go ahead, Michael.
I just wanted to add one, because we talked a lot about valuation, and I agree that discipline and methodology to valuation is always important, because we cannot be market timers. We're obviously looking at upside on technologies, but the one thing I'll just say is that the kind of investing we're all engaged in, whether it's at the seed level or the growth level, we cannot be hung up on TAM. I don't like the notion of, total addressable market analysis and so on, because the opportunities when you've got such threshold changes in technology, inflection points, is that you're going to create new opportunities. When Uber came along, the entire taxi market in San Francisco was $500 million.
Right.
5 years later, it was worth over $5 billion. It's just people change their behavior to drive, being driven around. AI is the same kind of thing at every level. Right now, as a thought experiment, and I'm also, just working on OpenAI, is out there, and they've not announced it, but, the current funding round is $6.5 billion at $150 billion valuation. And as an analyst,
God bless
that
America.
always attracts me. No, that attracts me like bee to honey, because that's an analyst's dream. I'm an analyst. And so, you run the thresholds of, okay, make that a 5x or a 10x. What does it entail in terms of the model? And you can build a very cohesive, thoughtful, and believable set of models on various array of probabilities to get there, even at 150 billion, is what I'm trying to say. My point is, even with the numbers as astronomical as they are, as long as the founders, the company executes, the opportunity set is there to bring the future forward, which was, I think, a wonderful way you phrased it, Mike. And so I just wanted to underline that I agree with the valuation piece. At the same time, we have to be open-ended in terms of how we think about valuation in terms of our methodology.
Yeah, and Michael, one of these days when we have more time, I'd like to talk to you about some of that, because the thing that I wonder about with OpenAI is I don't know if their core economics yet work in the way that they did for Google or NVIDIA or Microsoft.
Well, they don't until there's an unlock that we haven't seen.
And so to me, that would be the question: is like, do you believe that there is some type of a flywheel of legitimate compounding that could happen?
Yes.
And
Yes.
you could argue and win that argument, right? But like it's not as obvious to me as some of these other ones.
This will add another hour, but we don't have another hour. Yes,
Yeah.
I love the notion of flywheel. I've done an OpenAI set of flywheels, but Google, Amazon flywheels are just guideposts. We cannot copy them.
Right.
Those were different things, different times. We can tell Google stories here for another half hour about how Google became Google. It was a series of execution, technology innovations, and a series of accidents. OpenAI is going to have the same set of things ahead of them, or somebody else, or Anthropic for that matter.
And same with NVIDIA, only more so, right?
And NVIDIA, I've done the same. I'm doing the same exercise on NVIDIA at 3 trillion. Can it be a 5x?
Yeah.
Okay. And it's not unreasonable to construct that model in the world we're in, a world of 40, 50 billion agents, because of the compute required.
Yeah.
And the other word I would just highlight, and we should just, because you use the word commodification, I hear that all the time. Everyone is in a hurry in our tech business to identify which areas are going to get commodified. We always assume that it's the technology at the lower end is going to become a commodity, and everything on the top end of the tech stack is going to be the application layer. And that's my chart that I talk about a lot. This time, because the compute is so intrinsically part of the mechanism to create the value, the answers that people want, whether you're a business or a consumer, to me, the whole vertical stack is actually very different than in the PC or the internet or Google stack, et cetera. And so we have to be keep ourselves open to entirely new ways to use these stacks of technology, which is the exact lesson you wonderfully started with your Justin Twitch story. The camera on his head is now a $500 billion influencer economy next year. Because everyone is now
we're truly at the creator karma. There was all these VCs investing in creator platforms. The platform is not the thing. The creator is the thing. One last question, Mike, I'll let you go. When I say the word founder friendly, what does that mean to you as someone who's returned money to their LPs? Who are you working for?
Well, if you're raising money from investors, your primary job is to make them money. And if I don't want to do that job, I can not raise from other investors. I can invest just my own money. But like with founder friendly, it's interesting. I look at it slightly different. So like I invest way too early, sometimes legally ambiguously too early, right? And so the thing I think people don't fully appreciate about startups, and maybe you do, Howard, because you've lived it, it's fucking hard. It is not a fun job, right? Like being a founder is not fun. It's not a comfortable existence. It's, excuse my French, by the way, but like, it's like, but
French
it's
is great.
raw. It's raw and visceral in the way I just said. It's like, it is not a, if anything, the problem we have in startups is too many founders don't understand that, and they're playing house, right? They're
They're
not,
being lied to. They're
right.
being lied to.
And they're interested in the theater of startups, and what they name their conference room and 5 flavors of coconut water in the fridge and that kind of stuff. But like real entrepreneurship is hard because like if you have a breakthrough idea, most people think it's stupid. Most people don't listen to you.
It's only the beginning. The breakthrough is only the beginning.
And nobody's paying attention to you. Nobody cares about what you're doing. It's kind of axiomatic that they won't because it's so contrary to what they know. And so like what I find to me founder friendly is just honoring that fact in your interactions with founders. Like there are times when I can't give them more money just because it's not responsible for me to. But like to me, being founder friendly is about saying, look, I get what journey you're on, and I get that this is freaking hard. And like, I'm not going to be a reason for it to be harder. It's hard enough as it is.
But I work for my LPs.
Yeah, but I work for my LPs.
Okay.
Yeah,
So
just like the founder works for the customer.
This is something my beef with Fred is you can't write a blog post and say you're founder friendly without explaining the context of it, because there's a generation of kids that took this and interpreted it. It's kind of like colonizer, non-colonizer. I go, Fred, it's not the same, obviously. We're not killing people, but like we work for LPs, right? Well, our LPs are going to go into the data when we least expect it. And you need to answer to your LPs. And I think people have bastardized as founder friendly. So I appreciate your answer. That is the right answer. Yeah. We appreciate that.
Since you brought up how founder friendly, I would love to get both your input on the current debate in Silicon Valley around founder mode.
I don't think there's an argument. I don't think it's his best essay. I've become not it just sounded glib. I don't even know what it means. I think Mike nailed it. I think like we are founder friendly, but you got to understand that we're founder friendly because it's a fucking, we're going to have to be talking together in 17 years. Hopefully we'll stay friends and become founder friends, but I got to return money to my LPs. I just don't feel like people are getting the right message about that. So,
and I think that there's, it reminds me of like when people say disagreeable people are hard to deal with and they're unpleasant and stuff like that. But if you're overly agreeable, it's just a different type of inauthenticity. And so like, I think that you want to be authentic, right? And you want to have an authentic relationship with a founder, because the fact is, if they take money, they should care about a return for their investors, just like I do for mine. And that's just that's just business 101. That's just laws of space, time, and gravity and running a startup. And so like they need to care about that. Otherwise they shouldn't raise the money. And I need to be honest about that fact. Right. And I'm not being friendly or unfriendly by saying that. I'm just telling them the truth, right, about stuff. But I do think that what the founders really benefit most from, I think, is when they can trust their investor, when they know where they stand, when people don't change their mind over capricious things, where they know like what needs to happen to be successful, and you're not changing the rules on them all the time because you got ADD and you changed, your mind from one meeting to the next.
I just think, Mike, my short answer, Parekh, is that it should be investor mode. I think that we've swung the pendulum too far in favor of the founder, and people need to be writing about how to be a good investor, because it takes two to tango. And it seems like the founders are leading, and you need good investors defining some boundaries. And
I love it.
And people have forgotten about the LPs. Now, granted, we got a lot of dumb LPs because of ZERP and all the other things, but it's still no excuse. We got to bring back more Mike Maples is what I would say.
And I will second investor mode. I love the phrase, Howard. I think you're onto something. And I will also speak for the public side because of my background. Investor mode also means single tier tech stocks. This notion of 10-to-1 governance rights to founders that was also, in my view, of the pendulum swinging too much one or the other, because companies are going to become what they are. It'll take them 20, 30 years, and you need all investors to be on the same level and equality. So I throw that in on the investor mode suggestion.
So I'm a little bit more. I actually kind of liked the founder mode essay, but perhaps I'm talking my book because I like doing things with YC. But like I thought that I thought that there is a tendency in some companies when they try to scale, quote unquote, scale, to overly abstract management, and I think that to me, founder mode was sort of like it's similar to investor mode in the sense that you're not going to outperform the average by doing general management. You're gonna create general results that are sort of more within the average. And so I think that the founder mode, one way to look at it is the founder has to be the last word on what does outperformance look like. And that's for products, that's for returns, that's for everything about the company since they're a company. But I do think that there were some ideas in that essay that were really, that had a lot of merit to them. And
Of course.
and it struck a nerve for a reason, right? A lot of people were talking about it for a reason.
You got what it needed, a great conversation. I look at it, I feel I'm on both hats. I truly am both hats, maybe not good at either, but I try and humbly go as like, hey, people have forgotten what it's like to be an investor for some reason. Maybe it was too easy, 06 to 2014. And maybe it needs to get harder, but like the pendulum has swung, and I think if the investors don't want to stick up for themselves, they're going to get fucked. I mean, I get that. Just feels like I'm the only guy saying, wait a minute, what about the investors? But maybe the investors don't care. I don't know. But it's a fascinating moment for that, meaning I think that's what made it a great post. I'm not a guy who has been able to write viral posts. So who am I to comment on what his real reason was for writing it? And, I don't have the ability to tap the zeitgeist like certain people do. So I'm always the guy yelling at the zeitgeist. So, I understand that position that he has. But I feel like the pendulum is gotten out of hand. So we'll see. But it's good to see that you're excited. We took too much of your time, but wow, this is a thrill. We probably didn't cover anything that you expected to cover, but who cares?
Who cares?
I mean, you care, but hopefully we covered enough that
Pattern breakers by the book.
Yes, we'll send it out.
I just enjoyed talking to you guys. This could have been a meeting. This would have just been a fun thing to talk about.
Who knows if we even recorded? We're not very good at this, so maybe this won't even be out. I'm a pattern breaker. We just don't know if it's gonna fucking show up. What
By
a
the
pleasure,
way, Howard. I
like your smile. That was just fun.
Yeah.
Michael Parekh has a great smile. It's good to see that, Mike, that you have a great smile. People need to smile more. But pleasure to meet you. Pleasure to meet you here.
Pleasure to meet you.
Yeah. Thanks for taking
Wonderful.
the time. It's good to see you guys.
Thank you.
Thanks.
Thank you, everybody.
Okay.
All right. Thanks.